Hello, I'm Haider Malik, host of the MEMI Financial Group podcast. Today's topic is scaling to global markets, export financing for Surrey manufacturers. Selling abroad unlocks growth, but extended payment terms, currency risk, and upfront export market costs can strain cash flow. Here's how to layer financing tools so Surrey firms can bid, build, and ship internationally without tying up working capital. 1. Export working capital loans. Structure. Government-backed facilities, e.g., EDC's Canadian Export Financing Facility, provide working capital loans up to 100% of export invoices or foreign buyer contracts, often at prime, plus 0.51%. Benefit. Funds raw material purchases, production runs, and freight before shipment. Repay upon receipt of export proceeds. D. Tip. Use pre-approved revolving loans keyed to your largest export contracts so you draw only what you need. 2. Buyer financing and credit insurance. Buyer financing. Through Export Development Canada or partnering banks, extend credit to your foreign buyers via buyer financing programs. EDC guarantees up to 95% of the loan to the importer, so you get paid immediately by the financier. Credit insurance. Protect receivables against buyer non-payment or political risk. Premiums run 0.3-0.8% of insured turnover and unlock higher advance rates on receivables lines. Tip. Secure insurance first. Lenders will advance up to 100% of insured invoices with minimal collateral. 3. Working capital lines and factoring. Receivables line. Pledge insured export receivables to your bank for advances up to 90% of face value. Interest applies only to drawn balances. Export factoring. Sell foreign currency invoices to a factor at 80-90% advance. They manage collection and FX, remitting remaining balance less fees. Tip. Combine insurance and factoring to minimize risk and maximize immediate liquidity, especially in unfamiliar markets. 4. Government grants and subsidies. CAN Export Program. Grants of up to $75,000, 50% of eligible expenses, for market research, trade shows, and partner visits. Provincial supports. BC Trade and Invest offers matching funds for mission costs, translation, and local agent fees. Tip. Sequence your financing draws so grant reimbursement follows working capital borrowing, avoiding cash flow gaps. 5. Foreign currency management. Forward contracts. Lock in FX rates today for future export invoice payments to eliminate currency swings. Currency lines. Specialized lines allow drawing in foreign currency. Repayments in local dollars adjust to prevailing spot rates. Tip. Integrate FX hedging costs into your overall financing model to compare true cost of capital. 6. Total cost and stress testing. NPV modeling. Build cash flow forecasts for each export deal. Include production, freight, duties, insurance, interest, hedging, and grant timing. Stress scenarios. Simulate 30-day payment delays, 5% currency moves, and increased duties. Confirm debt service coverage and liquidity buffers hold up. 3 action steps. 1. Package your exports. Compile your top 3 target markets contracts, projected margins, and export cost breakdowns into a financing pitch. 2. Engage a trade finance partner. Approach your bank and EDC to negotiate export working capital facilities, buyer financing guarantees, and credit insurance structures. 3. Blend and optimize. Compare terms for loans, lines, factoring, and hedging, all secured by insured receivables, and choose the mix that minimizes financing cost while maximizing payment certainty. With export-backed loans, insured receivables facilities, buyer financing, factoring, government grants, and FX tools, Surrey manufacturers can scale confidently into global markets, securing growth without stretching cash flow. I'm Haider Malik. Thanks for listening.